In this video, I'm going to answer some questions that I've had from the community. So you can look in the comments box, you'll see the questions and timestamp, so you can jump straight to the question and listen to the answer, and I hope you find them useful. Generally speaking, most people who do commercial conversions end up buying properties in a limited company. However, as the question asks about LLPs, this is something which is worth considering. So what you could do is buy a property or commercial property in a limited company. If you then need to apply for planning, get the planning. If you don't need to apply for the planning, then you can obviously use permitted development. You can convert the property into residential and then move it into a limited company. Depending on the number of units you have or the number of flats you have, you could claim Section 162 incorporation relief, which means you pay no capital gains tax when you move the properties from an LLP into a limited company, and also no stamp duty land tax to pay because you bought it as a partnership, so you should be fine on that side there. When the properties go into a limited company, you'll have an increase in the base cost in terms of the value of the properties for the purposes of capital gains tax at some point in the future when the properties are sold through a limited company. This is not simple and it's not straightforward to do either, but it was a question asked by Ashley, so very quickly I've tried to answer it in a very simple manner. If you want to know more, drop me an email or make contact and I'll talk you through all the different tax advantages. There are some videos on here on the New England Club, which is a conversion that we did, and we used this particular strategy of LLP to a limited company and then refinanced with Aldermore. Have a look at that. That will tell you in more detail how this works, but feel free to contact me. I'll be happy to answer your questions. So the first part of the answer is yes, an LLP can own property in its own name because it obviously is a separate legal entity per se, so, and it can own land and property. I think there is a misunderstanding out there by some people who say an LLP can't own property and property has to be owned by the partners themselves. That's incorrect. Legally, an LLP can own property. The second part of the question is, do I have to file my own tax return as well? That is absolutely correct. So an LLP would file a partnership tax return, but an LLP is transparent for tax purposes. So what that means is the tax payable will be payable by the individual partners. So let's take an example where you've got three partners who own 33% each. So that's their profit share ratio. At the end of the year, they've taken a third each of the profits. So they would declare that 1/3 each on their individual tax returns and pay the tax based on their overall income. So one partner, let's say a third each is £33,000 for the purpose of this example. So one partner has no other income, they then pay the tax on the 33,000 using their personal allowance and the basic rate of tax. Another partner, let's say they've got another £50,000 worth of income because they work elsewhere. So their total income is 50,000 plus the 33,000, giving them £83,000. They then pay tax on the £83,000 when they file their tax return. So it all depends on how much income you've got in total, but to answer the question, yes, you pay the tax personally. And the final part of the answer to the question is, all profits have to be drawn out? No, you can leave the funds in an LLP and use them to grow your business for working capital, or just leave them if you want to. However, unlike a limited company, if you leave all of the profits in an LLP, you still pay tax on them personally. So let's go back to my example, where if you've got £33,000 worth of profit, which is yours, you're declaring that on your personal tax return and you have to pay tax on it personally. If it were in a limited company, on that £33,000, the company would pay 19% corporation tax at today's corporation tax rates. If you don't take the money out personally, you don't pay any further tax whatsoever. So linking that back to the earlier example where I said one partner only has £33,000, that person would pay basic rate of tax after using up their personal allowance. The other partner who's got £50,000 worth of other income plus £33,000, they will be paying 40% tax on that £33,000 because they've used up their basic rate of tax through the other income that they've got of £50,000. So you can see how maybe having a limited company in this particular example may be more tax efficient, but that depends on how much money you need personally. So if you don't need to draw money out personally because you've got income elsewhere, like the second person who's got £50,000 worth of income coming from elsewhere, for them a limited company would be possibly a better idea. We need to explore that more, but it could be a better idea. For the first person who's only got £33,000 income from that partnership, for them possibly a limited company might not be the best route right now. So it's horses for courses. It depends on your overall situation and circumstances, what you're looking to achieve, who's involved, and most importantly, how big the business will be at some point in the future. So you need to think about all of those things and also look at limited liability, management style, the tax consequences, the accountancy fees, any legal fees involved. So you need to think about all of those things before you decide which structure is best for you. Question from somebody, which is they are looking to sell one of their investment properties to free up some cash, and then they want to reinvest that cash into buying and refurbishing properties and then selling them on. And they're saying, is the best thing to do to set up a limited company and loan the money via a director's loan? And the answer is, it kind of depends to some extent. So let's first cover your first point, which is if you have an investment property and you're looking to sell it, remember you'll have to pay capital gains tax if you own it in your own name, which I assume you do, because that's the only way you're going to be able to obviously use those funds as a loan to your limited company. So on that assumption, you'll have some capital gains tax to pay. If you've lived in the property, then obviously some of it will qualify as your principal private residence. So work out how much tax you need to pay so that the figure that you've quoted of £250,000 might be less, because you might not have taken into account the capital gains tax, or if you already have, then that's fine. Then the 250 left over. Just so you're aware, if you're looking to do this a number of times, which is what you've said in your question, then this is going to be trading income and not investment income, just in case you're thinking of using up your annual exemption for capital gains tax purposes. This is a trading activity. So based on that, and depending on how much other income you have and how much profit you're going to make every year, it could be that limited company could be the best way forward. And the reason why I say that is your £250,000 goes in to the company. You can then charge interest on those funds depending on your personal income for income tax purposes, and you can obviously, the company will get a deduction for the interest it pays you. When you make profit, you'll pay 19% corporation tax on those profits. If you don't need any of that income personally because you've got other income coming in, it could be a pension or other investments or some other business. I don't know enough about you based on your question, but if you've got other income, then you may not need to rely on the profits you're making from these flips, which means if you're running it through a limited company, you're only paying 19% corporation tax. So the other 81% of the profit left over, you can then recycle into future deals. Now, I don't know how much profit you're making overall, but going forward, you'll pay 90% corporation tax if your profits are less than £50,000, and then the tax is tapered, and you'll have to pay a higher amount of tax, which kicks in next year. So you don't need to worry about that right now, but that's something you should be including in your calculations going forward, because the rates will vary depending on how much profit you make overall. If you don't have any other income whatsoever and you need to rely on this, then you might be better off doing some of the transactions in your own name, simply because obviously if you're running it through a company, you'll pay corporation tax, then you will need to take the money out personally. Apart from using your personal allowance, you might take a dividend, so you'll have to, the first £2,000 will be tax free, but after that you'll have to pay tax on the dividend, plus you're paying the corporation tax. So then you need to do the calculations to figure out which one works well. But if you have other income, then of course stick to running it through a company. If you're charging interest on the loan, and that's enough to see you through, or you've got some other personal income and some of the interest you're charging on the loan is going to be enough to look after your personal expenditure, then again run it through a company. But if you're not sure and you don't know what to do, speak to an accountant just so they can run you through the numbers so you can be crystal clear, because to give you a blanket answer of saying go limited, don't go limited, won't be the right thing to do, because it depends on your situation and your personal circumstances. The answer to this question is it depends, and it depends on your plan, because if you're looking to aggressively buy more property, then managing the properties is going to take up your time. You want to use that time growing your portfolio, not managing the properties. On the other hand, if you're employed full-time, you won't have time to manage your properties. Or if you have another business or other business interests, you might not have time to manage those properties, so you're better off paying 10, 12, 15%, whatever an agent charges to look after those properties for you, so you can focus on the high value stuff. Obviously, if you have expertise in managing properties yourself, then you might want to do it yourself. But generally speaking, I think is my time better spent on doing the real high value stuff that I'm really good at, or am I better off trying to manage properties and save 10%? For me, it's spend time on the high value stuff that I'm really good at, pay somebody else 10%. The same links in with, are you better off doing your own bookkeeping and spending loads of time learning all that, making errors and fixing them, or paying a bookkeeper or an accountant to do that for you? Well, the answer really is pay a bookkeeper or an accountant, do it for you, because they're the experts, they're good at it. You do what you're good at, let others do what they are good at. So that's what I do, and that's what I would recommend to you. In this video, I answer 3 questions from Lekhan Lij. The first one is, how do I find a property manager? The second one is, how do I prepare a schedule of works, or where do I go to get one prepared? And the third part of the question is, how do I draft suitable contracts? Finding a property manager or recruiting anybody is always an interesting challenge, and where to look for people is also interesting. So I'll just share my experience with you of how you could possibly do it, and then there's other avenues available as well, of course. So to start off with, I'd say the kind of things that I see people using a lot, LinkedIn, that works incredibly well. It's a very effective tool, so you can think about advertising on there. If you have your own website, you can put it on there. Use other forms of social media, including Facebook. That seems to work well. You've got Indeed, and that can be hit and miss depending on how specialist a job you're looking for, and how much money you're willing to pay to advertise the job via Indeed. But we've been able to get some really good candidates and team members through Indeed over the years. Like I said, it's hit and miss, but it can work well. So it's a good place to start. You can do the free advert first to see the kind of interest that's available out there. Then you've got online job boards, which charge you like say £300 and advertise it on quite a few different job boards. That can help you get people in. Something else which has worked really well for me, especially, is when I'm out there networking, talking to people. You get to know people who are either working somewhere and maybe looking for a job, or you talk to people who know other people who may be looking for a job, and that helps you get or find people. Especially if you're looking for a property manager, go to property networking meetings. You'll meet people there, and that should be a good avenue alongside of Chamber of Commerce and elsewhere. So that works well. And then if you can't still find somebody, then go to a recruitment agency. You're going to have to pay for it, by the way, but they'll find you somebody, and the fees differ depending on the seniority of the person and their salary. So if you find somebody where they'll charge you 10% for somebody, you'll do well. But for someone like a property manager, I'd say you're looking at between 20 to 30% of their first year's salary. So those are some of the opportunities and areas you can explore to find someone as a property manager. And if you try all the low cost and the cheaper ones first, if you haven't got the budget, then okay, it's a good starting point. If you have got the budget and you want someone to start fast and you don't want to waste time or invest time in trying to find somebody, then go straight to a recruitment agency. So it all depends on your budget and how much time you've got. The second part of your question is in terms of doing schedule of works. So I have my own project manager and I have my own head of construction, and they will do all that for me. If you haven't got that, then what you could do is, if you have a quantity surveyor, they can do that for you. If you have an architect or you've engaged with an architect, they will prepare a schedule of works for you, and then you can use that. If you're going to use a main contractor, you can ask them to do that for you, and that's a possibility. So it depends on who you've got on your team or who you're outsourcing some of the work to, and those people will be able to prepare a schedule of works for you. And then the final part of your question in terms of suitable contracts, I always use a commercial law office firm, and they prepare contracts for me. But two other options available to you. I'm not saying these two are what you should do, but A is, if you don't have the budget but you've got somebody who has contracts and they may allow you to use them and you might need to change them around, that's a possibility. A lawyer will say to you, don't do that, because they need to be bespoke. But when you haven't got the money, you need to start somewhere. So having something is better than having nothing. So that could be a possibility, although it's not one that I recommend. The second one is, there are online websites which you can go to buy draft sample contracts. Again, not perfect, but at least you can have a draft contract and use that for the time being until you've got the funds to engage a solicitor and get them to draft your contracts. But in my experience, by far the best is to engage a solicitor from day one, get them to draft all your contracts, because the law and the regulations keep changing. A good commercial solicitor and a good firm keep on top of all of those things, so they'll be able to share with you exactly what needs to be in the contract, and then they'll be asking you questions about things that you haven't thought about and you probably wouldn't ever think about. So they'll get all that covered for you. So it's a good contract which protects you, and a good contract should also, of course, protect the people who are working with you as well. So it should always be fair to both parties. So I'd recommend using a lawyer, but again, it all depends on your budget. And if you click this video here, I recorded something on Power Teams which you'll find useful, and below that, if you click the subscribe button, then we'll keep you updated with all the regular content to do with property and tax.